Welcome back to Vantage. When you know that there's going to be a manager down from Edinburgh, it's really important you go and grab them. We are delighted to have this manager on the show. She's come into our London offices to talk about her fund. They've got a very different approach to a lot of small and mid-cap funds, investing in certain sectors that others don't. We're going to hear a little bit about that. I love the team-based approach that they take, and it's been a very successful journey for them. They've managed to scale significantly over the last 5 years. We also reflect on, the current market volatility that we're seeing as a result of the sort of Russia-Ukraine crisis, and also think a little bit about the IPOs that came to market last year and how they're faring. And she talks a little bit about, what they were picking last year. Let's go and take a look. Welcome back to Vantage. I'm delighted to have a small and mid-cap fund manager on the show, Anna MacDonald from Amati Global Investors. Anna, welcome to the show.
Thank you very much for having me.
You're down from Scotland. I think we have to start by, we can't ignore the events of the world. We have the Russian invasion of Ukraine. It's led to an enormous amount of turbulence in the market over the last 3 weeks. I'm just curious to get your perspective on what we're seeing in the markets and how you're navigating through that.
Well, I mean, aside from the human tragedy of it, we do have to think about how we're best going to safeguard our clients' money during this time. And we have to take a step back and acknowledge that the volatility that we see in markets is going to be extreme, and we have to be really careful when we're making decisions around that. It also comes on the end of what's been an extraordinary couple of years after the pandemic, and positioning was already pretty challenging. We found 2021 a really tricky year. This year we've actually been doing all right, and I think we haven't really done any worse or better than the overall market. And that's really been because I think we've done better than some of our peers because we've got a slightly different approach, and we do own, for example, oil and gas stocks, which have been the standout performers this year. Yeah,
we'll come and talk about the fund diversity and actually some of your sort of early positioning moves, which I thought were quite interesting. Before we get into that, I think it's always good to get to know the personality a little bit and the history and the journey that brought you into the current role at Amati. Why don't you talk through your background and what brought you into fund management and the current role?
Of course. I have been at Amati for 4 years. But I've been a fund manager since 1998. I joined Henderson Investors. I didn't do any milk round or anything like that. I thought I was going to go off. I had a vision of learning Mandarin in Taiwan for a bit. So I went to visit the university there, and then, I don't know, I think I had a realization it was going to take me an awfully long time to do it, and did I really want to do it? So I came back to London, and I got a job at Henderson Investors, and I was very lucky to be recruited by Andrew Formica and to work with him on the, first of all, just pretty much on the passive side. So I learned a lot about spreadsheets, and then got really, I think I annoyed him a lot by constantly saying I wanted to get into the active side. So I did the precocious thing of setting up my own little model portfolio and showing that I could deliver good returns. And I think by badgering got me where I wanted to be, which was work with him on the active side of what we had then, which was an enhanced index product. And then we spun that out into a UK market neutral hedge fund. So that was a fantastic experience. And then at the grand old age of 27, I decided that I'd go off and live in Kenya for a bit. So I did that. And had my first daughter there. I worked for a little while at Old Mutual Asset Management there. An incredibly different market, as you could imagine. Nairobi Stock Exchange is quite small, but it was at that stage when everyone was getting very excited about things. And there were memories of the dot-com experience when a stock split wouldn't be quite understood, and people suddenly thought that the shares were 10 times cheaper than they were the day before and things like that. So it was quite an extraordinary time. I came back to London, had a little spell at Threadneedle in London, but had decided then to move up to Edinburgh. So I joined Adam & Company, where I led the research process there, and worked a lot with Coots as well. Because I ran the IHT portfolio service for Adam, and then we also had clients from Coutts, I grew that quite substantially, and the performance was great. So I got to know a lot of those AIM stocks really well.
Yeah.
And the way that the world is in Edinburgh, it's quite a small place. Often you end up at the same company meeting as someone else. And I came across Doug Lawson from Amati several times, and we became friends, and it was clear our approach was quite similar. So when he had decided to set up a new venture and move on from Amati, they asked me to come and join them. So I did that and joined in 2018 when the funds were an awful lot smaller than they are now. And just after they'd done the deal with Amati AIM taking a small minority stake in the business. And I worked originally with David and Paul, and now we've expanded the team and expanded the assets, and it's been a fantastic journey to be on.
Yeah, we'll come on to that. And, you know, I'm from Kenya. I actually remember meeting you when you returned from Kenya, and you telling me the story of, you know, your clerk opening up the Nation newspaper and transposing the share prices into the spreadsheet. It's a very different world.
It really is.
So you then joined Amati, and you've touched a little bit of the history, but talk to me about the growth of the assets and how it's been sort of scaled up, and also the range of funds currently and what you're particularly involved in.
Okay. I'm involved in 3 funds principally. So the Amati Smaller Companies Fund, which was only around 100 million when I joined. And then there's also the Amati AIM VCT, which is an amalgamation of different VCTs that have been around really since 2005.
Yeah.
And then the IHT portfolio service, which Amati launched in 2014. And the funds, particularly in the Smaller Companies Fund, they reached that critical mass where, as I'm sure other fund managers have said to you, you know, it's a struggle to get to that first 50 million AUM, a real struggle. And gosh, it took years for Paul and the others to get there. Then it's sort of slightly quicker to 100. And then once you've reached 100, that trajectory, if the performance is good, is pretty quick. And it really was quite quick. Lots of inflows. We've got a great sales team. And I'm really proud that our process has managed to stay very consistent during that time, despite the increasing assets. The VCT is around 250 million AUM at the moment. The great thing about Paul having run these VCTs for such a long time is that Amati's always been profitable, and it's always been, you know, and it's always been able to invest in its own technology and all that kind of thing. So it's a very well run, cleanly run business.
Yeah.
And the VCT, given the vintage of some of our investments, I guess, we've got some really substantial companies in there that we've owned since year dot.
Yeah.
So we've got Craneware, we've got GB Group, Keyword Studios, Frontier Developments. And so the top 10 holdings in the VCT are really, you know, they're very well-known companies that are not, you know, they're at a completely different risk level than something that a new entrant, a biotech stock or something that might be. So VCT investors are able to get exposure to the advantages that a VCT brings, yet whilst it's always going to be riskier than your average, you know, large cap investment, you're going to have some really good stocks in there, about half of them with, you know, really decent market caps and so on. So that's really positive.
No, and I think you're doing yourself a little bit of a underservice in that it's not just inflows. I think the organic growth of the fund's been good, particularly on a sort of 5-year basis. When you look at the track record, that's good. And I think that the advantage of having this VCT is that you get to see these companies and the management teams very early on, and look at some fabulous success stories.
Yes, and what we consider the VCT as a kind of nursery as well. So we want, you know, we'll get to know these companies pre-IPO, of course, go through IPO with them, go through early days, which are not sometimes the best fun. Potential further fundraisings. We get to know those companies really well. And once we feel they're a bit more mature and consistent, then they're bound to become candidates for or considerations for the smaller companies fund as well. So we've got about, I think at the moment it's high single digits percentage of overlap between the smaller companies fund and the VCT. But even just getting to know those companies just informs so much about the wider market.
Yeah.
And just, I think it gives us that really genuine bottom-up small cap focus. It's not, we're not sort of, I don't think we feel like it, I don't know, it's not like we're a sort of small cap team slotted into a much bigger institution. We kind of live and breathe the small cap.
I don't know, when we talk, you get that culture coming through when you talk to Amati.
And then the IHG portfolios, they're about 50 million now and are growing and are doing really well actually. So that's been quite good. And we've just now launched, so I look at those funds and it's the 1 year anniversary now of our strategic metals fund, which has had a really particularly brilliant couple of months.
It's very timely.
Yes. Well, Paul was looking around for a strategic metals fund that he wanted to invest in personally and couldn't find one. So he looked around for some good managers, and we've persuaded them to come to us.
Okay,
great.
So let's talk a little bit about the investment process, and I think you touched on the fact that Amati's invested in its own technology, and there's some things I think that differentiate you from others in terms of that technology. Walk us through, how when you're thinking about investing in a company, the process that goes on at Amati.
Okay. Paul devised with our IT guy, Wolf, who's been there since the very beginning, a system called Connex. And it's really, I suppose it's like a database, a CRM or something, but we record on there, you'll have an entry on there. It'll say where you work. Any conversations that I've had with you would be put under Neil Shah or put under Edison. And then for every company we've met, we'll any kind of interaction we've had, whether it's a company meeting, a phone call, discussion with an analyst on the stock, anything, it's all in one place. And that gives us a fantastic corporate memory. And actually, sometimes that corporate memory goes back longer than those management teams.
Yeah.
And I think they have often been surprised when you can refer back to something that was probably even before their time. But even in more recent history, it's very useful to have a meeting with management and they talk about something and you can hold them to account 6 months later or a year later. And so everything goes on there. And then we write, if we're proposing it for an investment or if we're proposing it as a sale eventually, we will write a conclusion. Now, none of this we're a close-knit team. We talk all the time. None of this is going to come as a major surprise. It's not the kind of, we don't wait till a Tuesday afternoon to sort of come out with some surprise stock buy idea. We know what each other's thinking about. And so that we might decide to write, say we're writing a buy conclusion, we like a company, we will cover valuation, we'll look at it, how it might look on Quest, we'll speak to brokers, we'll speak to the research analysts, and we'll write a considered conclusion about the stock and send it out to the rest of the team, which means if someone's working from home or someone's traveling, we can still all see it. Yeah. And we get together and chat and we vote. And sometimes, most of the time it's unanimous. Sometimes it's not, and that's not seen as no one has a veto, but what I would say is that if someone feels very strongly, it's just a spur for more conversation, for more discussion, for more notes, and then finally a decision's reached. And we do that when in reverse as well. And what's really useful is that it becomes the conclusions, and we'll say each one's saved. So the buy will be saved, the add will be saved, the reduce, whatever. It really does help you understand the evolution of your thinking, and sometimes you will actually write about the risks that you see in that business in a conclusion that then actually really do come to bear, and you think actually it's really important to understand why you were thinking what you were thinking at the time, and the different motivations for it and the different risks, because it helps you learn then from your mistakes that you made. Because I think putting your head in the hands and going, why did I do that, is not a very helpful way of thinking about it. Going back to the conclusion, saying, what was I thinking at the time? What did I not see? What did I see? Is really helpful. And sometimes we will write a conclusion, say something has got overstretched valuation, write a conclusion, say there's nothing wrong with this company. So if we get a really good re-entry point, let's think about it.
Yeah, you come back.
And actually, we did that last year with GB Group. We felt, you know, that there were other probably better value opportunities in the market, and we sold it. But I wrote in the conclusion, I expect they'll come back to the market if they're doing a really interesting acquisition. And they did come back to the market.
Yeah.
They did an interesting acquisition. So that seemed pretty attractive. You know, sorry, not attractive. It made sense to us, you know, and it wasn't, we don't feel like we're coming at everything from scratch all over. You know, we read what we thought about it before, and then we act on it. So it's a really useful way of working and a way of thinking really methodically and carefully.
Yeah, and I think as you peel that back, you know, when you talk to teams of fund managers who sit and have that conversation and have space for a dissenting voice, it speaks volumes of a sort of culture where, I mean, it's not personal, you know, but it's creating space for different opinions, hearing and challenging the views, and I think that sort of I think it sort of speaks quite a lot about the team at Amati in terms of how you work.
Yeah.
Let me touch on the diversity of the fund, because you are different to a lot of small cap fund managers. Or for small cap funds, there's people who won't touch certain sectors because they don't have earnings and things like that. But talk to me about what is different about the Amati fund, and a little bit about how that contributes to the diversity of the fund.
Yeah. I think you touched on it with the VCT nursery idea, that we perhaps will be happy to hold companies probably at an earlier stage than others would, because for us it's not early.
Yeah.
And there's nothing, and it's not meant to sound smug in any way, but there is nothing like a broker calling you up and saying, "Oh, we've just initiated on this stock you've probably never heard of." And you think, well, actually, we really have, and we know this company quite well. So I think that gives us an opportunity to invest earlier, and I also think that the coverage that we have of every sector and across both AIM, if I'm talking about smaller companies fund, across both AIM and main market, gives us a really good knowledge that's really broad of our universe. And for example, Gareth Blades, who joined us, very luckily we hired a biotech specialist in July 2019, just before the pandemic. But I mean, having his understanding on not only on coronavirus, but on the vaccines, what mRNA was, having what the trials were like, what the efficacy rates were like, what the treatments were like, is hugely positive. Just for your understanding of, you know, he understood when that Pfizer trial data got published, and this is enormous, you know, this is stunning, you know, and when the AstraZeneca vaccine, you know, he said 70% is amazing, you know, I mean, so that sounds maybe all very sort of, you know, basic, but it's really useful to have that opportunity. But also he brings his healthcare knowledge, and I think that's one sector that a lot of fund managers have been put up. I'm not talking about the very well established pharmaceutical companies, but smaller end pharmaceuticals. It's a sort of scary sector, and it also requires you can't do that sector unless you really know and understand what's going on within it. So that's been really helpful. Paul has always been keen and thought there's a strong investment case for mining and energy stocks, and you know we've shared that view. But he's very used to investing in those stocks. He's used they can be quite risky, particularly at the small cap end. So you know the position sizes need to be small. They need to be very considered. You need to understand what you're doing, and we devote quite a lot of time. He devotes quite a lot of time to that too. So I think it's our real true waterfront coverage and an understanding of. I mean, Paul's been buying oil and gas and mining stocks for 20 years. You know, he really does have a deep understanding of that area, and obviously our new strategic metals fund guys are really helpful as well in that respect. Yeah, they've got lots of industry background as well, and I think we've always felt that ESG, some ESG mandates are quite wrong-headed in their approach, that they are driving outcomes that aren't necessarily particularly environmental, sustainable, or good governance to us. And we actually think, we've always thought it should be called ESG-H anyway, and H being human capital, human issues. If you look at how the way that Russia, for example, is behaving at the moment, that we'd never want to invest in Russia. We would look at that, and we'd look at something like the Freedom House score of Russia, which is the level of press freedom. 0 is no freedom at all. 100 is you can say whatever you like.
Yeah.
Russia's about 10.
Yeah.
We would never invest in that jurisdiction, and that's really important to us because you tend to find that these where you do invest in poor jurisdictions, the shareholders are very far down the list. Things can change very quickly for them. They don't treat people well. They don't treat employees well. That to us is a really unethical investment, and I think that actually the drive to ESG has ignored things at our peril, which we are now seeing. For example, in oil and gas, I mean, I think obviously the environmental impact is very important to consider, but energy sources need to be considering that. They need to be considering the security of supply, the affordability of supply. You can't just drive one of these 3 things and expect that you're going to have good outcomes. And I think now it's been quite astonishing seeing hastily arranged calls for ESG investors saying things like, "Is defence stocks now the new ESG?"
Yeah, I think we are going to start to see that. I think we're going to see a slightly more sort of grown-up discussion around it, and I definitely sense that the fund management community, the investment community, is focused less on the scoring around ESG and now much more on what is sensible impact, and which I think is right, and it's a healthy debate to have, and hopefully we end up doing the right things as a result of that.
Yeah.
You talked about investing in Bartek and oils. I mean, we get lots of managers talking about conventional names, a Dunelm or something like that. We don't get many managers talking about. Can you pick out something in your portfolio or a couple of names in your portfolio that illustrate that approach?
I can talk about i3 Energy. We bought that in a placing in July 2021. And I think i3 Energy, actually, I think the whole sector was almost at peak ESG hatred of. Hatred. This is getting a bit strong, probably. It probably the oil sector was probably at peak. No one wanted to touch it. Yeah. So Paul had been quite familiar with i3, and here we have an example of Connex working very well. He was on holiday. I took the call on the wall crossing. Spoke to the company, used Paul's notes and discussed it with analysts, had a quick chat with Paul and the rest of the team, wrote my conclusion. And what they were doing was they have assets in Canada, jurisdiction we can easily live with. Yeah. There was a forced seller, really, of some overlapping assets and extra pipeline. So fantastically accretive deal. I mean, unbelievably accretive deal. And it made an awful lot of sense to us. And so we took part in that placing, and I think it was about 10p. And now it's risen up to 23, 24 pence. But not only that, it's paying out a significant dividend. And at current prices, there's absolutely no reason it won't continue to do so. Interestingly, and I think this is perhaps. I'd never seen this before. They announced they'd start paying a monthly dividend because they wanted to attract some income investors. Okay. And that is an interesting side to oil and gas. Is I was listening to a really good podcast by Michael Sembeles from JP Morgan, and he's been talking about the underinvestment in oil and gas for a long time. And his research shows that the 12 oil majors, the capex they've been spending is down 75% from the highs. And it's very little exploration happening now. It's just maintenance, it's production, that kind of thing. So there is and those companies are being urged to pay a lot out in dividends. I don't know how long that continues for. I mean, the free cash flow that they're generating is enormous, so they should be able to carry on paying good dividends. But I wonder if there will be, as you've talked about, a change of investor appetite, that acknowledgement that if we don't invest in our own exploration and production, then the bad actors will, and we don't particularly want that.
Yeah, I think there seems to be a immediate implication is national energy security is going to be brought to the fore, and what shape that is, I suspect, is going to be a spectrum of conventional and renewable sources.
And it makes the price differential for renewables, I mean, it makes that compelling. You should continue investing in renewables, and I'd always feel it's a bit unfair. And for example, BP, I mean, that's a huge company, we're never going to invest in it, but they spend an awful lot of time investing in renewables, yet they're not really given that much credit for it. And then there's also Serica. They provide 5% of the UK's natural gas supply from near the coast of Shetland. It's despite the fact that the gas price has rallied, I mean, it's been unbelievably volatile. I think it went from 300 to 800 at one point. I think that's a price per therm, and I was told by someone that's a 17 standard deviation event.
Yeah.
So pretty unusual. And it's not a surprise to see it winging back to 450, then back up to 500, then down to 300. But even at a high 200 share price, by the end of this year, most of Serica's market cap will be in cash. So it's on 3 times earnings. So that seems to us, that is a UK based production of natural gas is surely something that we would like to encourage rather than not. So I think that's kind of important. I don't want investors or people who are thinking about this fund to think that we don't think that the green transition is important. We do, and we invest for that too. But we just think the transition it doesn't happen overnight. European solar and wind generation has grown by 1% per annum since 2000 over the last 20 years. That's it. It still only provides 4% of global energy supply. Nuclear is around 10%. We're very up for the idea of more nuclear investment, and I think that is going to happen, hopefully. But we can't turn off the security of our own. This is what's going to drive the economy. There are some that think that economic growth is going to be hit this year, not by just the price of oil being so much that we have to spend less on other things and causing an economic downturn, but actually that we might not be able to get enough oil. So, I mean, there are some analysts who are starting to talk about that. Now, that's extraordinary, and we shouldn't be in that situation, because not having a healthy economy is not good for anyone.
No, absolutely. And, we keep an eye on that sort of supply chain disruption, and hopefully we'll find a way through that. There is, you talk about the risk of an economic downturn. Every time you see these sort of energy spikes, there is an impact on the economy. You've been positioning the portfolio away from consumer spend as one of the things that I picked up. I would like to understand, the thinking behind that, and I think you're quite early in doing that.
Yeah, well, there were some lockdown winners that it became clear would struggle to maintain that kind of earnings momentum, yet were still pretty highly rated. And I think, to their credit, management did think that a lot of these things were going to carry on. But as we all know, things do snap back. But some things do seem to have changed. I mean, absolutely, there have been some change in consumer patterns. But, we're not people who were doing online food delivery, online in supermarket shops. It's reverted pretty much all the way back to what it was. So that has not persisted in the same way. The high street has opened up a bit. And we do own some consumer stocks, but I think what we want to think about are stocks that are actually going to do better in the unlocking, and have a tilt to have it something extra to them as well. So I would highlight Accesso in there. So this is a company we've known since IPO. It's in the VCT, and we did have it in Smaller Companies Fund and sold it. I mean, it reached incredible valuations a few years ago, and we didn't sell it early enough. I remember that. We have gone back into that in the Smaller Companies Fund. We did that in January last year, and that's because the platform. I should explain what they do. So they do the ticketing and queuing and other software for things like theme parks and theatres and so on. And they had bought quite a few businesses, and finally they'd managed to, I think they're all quite well invested now, and the platform's working really well. They've got some very good clients like Merlin and Six Flags. Steve Brown, who previous CEO, has come back to run the business and brought on board a really strong CFO called MacDonald. And we are seeing that Accesso is benefiting not only from the fact that theme parks are opening up and people are going back to them, but I think there has been a genuine shift to expecting technology to work better as a consumer. So the idea of going to a hotel and being given a piece of paper to go onto the London Eye and, from the concierge, and then trotting down to the London Eye and then realising you've got a queue and maybe come back. People don't want to do that anymore. They want to be able to book online. They want to be able to, maybe for a theme park, they can buy a meal package as well. They can do different things. And so what Accesso are seeing is not only more people coming back to theme parks, obviously, but that a greater proportion of their spend is going through their software.
Yeah.
And so they benefit from that transactional revenue. So it's an opening up play, but it's also a kind of tech platform play, and we love that. We think that gives you really good margin protection. We've done some calls with industry experts, and we really can't see similar providers. There are basic point solutions that are available, and some of those are used by some of the theme parks, but otherwise theme parks usually tend to have their own software. And at some point, it becomes a really good idea to outsource that and have it on the cloud, and really good software. And they're working now also with things like ski resorts and so on. So just a really interesting company. And they're having challenges, like a lot of tech companies, in getting and keeping good people. But I think, they flagged that up. But I still think that, they're not based in Silicon Valley. So that makes it a little bit easier. But they're based most of the time in Florida, and so I think that's a pretty good.
Yeah, it's a stock. It's a stock I've always liked. I from the days when I think it used to be called LoQ when it first came to market, and I've sort of tracked it. And I now that I have children, I get exposure to their product when I've taken them to the sort of theme park. So I can see that, and I particularly like the angle of the fact that we've all been through the sort of digital journey over the last couple of years, and so now there is an expectation. So definitely one to take a look at. The IPO market was exceptionally buoyant over the last sort of 18, 24 months, and you had the pandemic. I thought you saw quite a lot of easing coming through from the sort of central banks, and all of that led to a flow of capital. And I think for a lot of private businesses, I do remember talking to people who ran businesses, thinking about the diversity of the capital base being really important as a result of the pandemic shock. So it was, people came to market because there was the window was open, but there's very good reasons to doing it. Walk us through, what you would have been shown quite a lot through that time. What did you like, and maybe some things that you chose not to invest in over that period?
Yes, I mean, from the moment the pandemic started, the level of deal flow that we saw was quite extraordinary.
Yeah.
And I think at first it was quite a lot to get used to, because we were all working from home for the first time ever. I do remember one very clear time being on a fundraising call and crossing my legs and managing to switch my computer off at the socket at the back. And frantically trying, it was another 4 p.m. call on a Friday. The deal's going to close in half an hour. One of those sort of just moments, and just everything went, oh. I was like scrabbling under it. Kind of thing that doesn't happen in the office.
Yeah.
So there was a lot to handle, as well as the stress of what was going on in the markets. And so we saw a lot of defensive fundraisers, particularly consumer stocks that really needed to bolster their balance sheet. So there was that to consider. Then, slightly more interesting for us would be the slightly more opportunistic raises, saying with companies that felt this was a great opportunity to be picking up some other, doing some M&A, picking up some deals. And then a rush of fundraisers of, if we don't raise now, then why is no one's going to have any money left to give to us? Those were also slightly less attractive fundraisers.
Yeah.
So we had to do that. And then, so that was normally secondary, it wasn't, when I say secondary fundraise, it was primary money, but it was stocks already listed.
Yeah.
And at the same time, Gareth was dealing with a lot of biotech stuff that was coming to market because of the pandemic and various different solutions, and companies wanting to raise because they thought they could do whatever it was that they were trying to, treatments and vaccines and things like that. So an extremely busy time, and we were pretty selective at that time. And as you say, there was just a flood of money into the market, and I think there was a slight fear that companies were going to stay private for longer. So people were encouraging them to try and list. And anytime you spoke to a broker, they'd be like, oh my God, wait till you see next quarter or something. It's all piling up. And I do remember last year, May, so we write everything on Connex. So we get the wall crossing email or the phone call, and we tap it into Connex and the size of the deal, who's doing, which fund manager is going to look after it and things. And I counted down at the end of May, and I think we'd had 42 wall crosses over that month. And that's a lot for even for a team of 5 to handle. That's a lot to do, because they each deserve proper care and attention. So I'd say that we became more and more selective the whole time, because we knew that in amongst some gems, there were quite a few things that were just coming because they thought, if we don't do it now, when are we going to be able to do it? So I think we were guilty a little bit of being swept up in some excitement of, oh my God, this is a really hot IPO. But most of the time we're quite good at not doing that. But some of the IPOs have not been great. Some have been fantastic. ATG, Auction Technology Group, it's rattled back in the tech sell-off recently, and it was a very highly valued stock. It was clear. I first met them actually in January 20, when they first thought about coming to market, but they decided to stay private for another year, and they bought another company in that time, and they then floated in February last year. The management team are deeply impressive. They're doing to the auction markets what Rightmove has done to the property market, or what Auto Trader has done to the car market. And the auction market is not just art and antiques. That's part of what they do, but it's industrial and commercial as well, which is a really substantial market. And a little bit like Accesso, yes, people do want to return to live auctions, particularly on the agricultural side. It's seen as, it's good communication with others, it's good getting out there. But there may be a farmer who needs to buy a new tractor who just hasn't got time to go, and to be able to go and do a live auction, a live auction which is with people in the room and with people online. It produces better prices, better liquidity. It draws more and more into that market. So it's not going backwards. I don't think it's a pandemic winner that's not going to be able to sustain that growth. And they've done some fantastic acquisitions. So I'd say Auction Technology Group, great IPO, has actually fallen a bit recently, even despite the fact that earnings are still, it's derated. Earnings are not they're going up, and they're doing very well. Dianomi was another great IPO. I don't know if you're familiar, if you've ever seen Taboola and Outbrain ads on even quite sort of like websites like where you wouldn't expect to find sort of odd ads about how to reduce belly fat in 5 days and things like that, or you know, dentures or stuff. And, you know, in publications where it seems to kind of jar, I think Dianomi have recognized that for several years, and they've built up a fantastic client base and of advertiser base and publisher base, and they can put relevant ads into the right places. So go to the Times business section, read something about Asia, you might see then an Asian exposed equity fund advertising there, something relevant. And this is not a new company. This has been trading for 10, 15 years. But they wanted to come to market, and that was something that was very much at the lower end of the market cap that we'd normally look at for smaller companies. But we were so confident in it that we were happy to buy that. And then TinyBuild, another one. Anyone who's met the CEO, I've never actually had a chance to meet him face to face, but he's currently without visa. He was Russian. I don't know if he still. I think he's. I don't actually. He lives at the moment in the Netherlands. I'm not quite sure. He's got lots of sympathy for what's going on right now in Ukraine, and he was a professional gamer. He's been playing games since he was 13, and he's built up a great business. As a games publisher, particularly famous for Hello Neighbor. But he finds interesting franchises. He works with developers, and he gets them to come in and buy into. You know, they buy into the business. Or sorry, they don't buy in, but you know, they become, instead of just being third-party publishers, they actually become first-party publishers of the game or the games. And they've developed some really fantastic IP, and they managed to keep these developers in there, creative and doing good things. They have got developers working in Ukraine and Russia, and they're doing what they can to help them, which is challenging, but I think if anyone can do it, Alex probably can. And so they're great little company. Did quite well after IPO, and then I think they've been tarred with the brush of the others have suffered in the gaming, with video gaming, which is there's quite a lot of congestion at the moment in the release schedule. But TinyBuild try and come at that quite differently, because they don't think taking over the Steam page on the day of your game's launch is perhaps the best way to do it. So they have an enormous social media presence and impact on social media. So I think they are slightly more innovative, and they've been doing that for a while. But they've come at that nice and early to try and get their customer base interacting with them like that.
I did hear, maybe I read it somewhere, that you haven't met him in person, but when you do, you're due to be challenged to a video game. Is that right?
I was. We were hoping to be able to do that. I'm not. I think, given that the last thing I played was on a BBC computer, Chucky Egg, back in 1986 or something, I don't really hold out much hope. But yes, I will try.
Look forward to that. That's something which we'll keep an eye on the Amati Twitter feed for.
Yeah. My absolutely sort of without a doubt defeat. So, yeah, that's okay. I can take it.
You did this series, which I used to tune in for, where you would actually talk to management teams of your investee companies, video them, and sort of put them out there, which I thought was really helpful for someone to understand the rationale as to why you're buying into the company, and you asking the management team about the business. What was the idea behind that?
Started off because we when we have our VCT AGM live in person in pre-COVID days, we'd have it at the Guildhall School of Music, and we'd always ask some of the companies to come and present to our investors. And that really used to help bring it to life a bit, the different investments that and to hope to get something not completely new, but maybe relatively new, that was a little bit established now in the VCT, and our investors really liked that. During lockdown, we wanted to continue that experience, so we did it first of all with our some of our VCT company holdings, and actually they were they were very up for the idea, and also it's quite easy for them because you're not having to travel to Guildford School of Music, which is where we do it usually, and you know it was just a video recorded at their convenience, and that was quite good. And now we've thought actually for the Smaller Companies Fund, it's something quite good to do as well, and we particularly felt that given our performance last year wasn't great, it was really important for our investors to understand the kind of companies that we're looking at, and to really sort of get, that some of them might not have done particularly well, but actually let's see what their plans are. Let's meet the management. Let's the best people to talk about the businesses that we're investing in are those CEOs and CFOs that can really bring it to life and help you think about the business. And so we've been doing a couple of with advisors and investors. We've been doing some big Zoom calls and had some companies on. So last time we had Vic Kist from Saietta, which is an IPO. Well, we actually invested pre-IPO in the VCT.
Yeah.
More at IPO and in the smaller companies fund. So we got him to come and talk about his amazing axial flow motors, which are going to transform the 125cc market in Asia. And we also had Robin Totterman from Inspecs, a company that we like to think might become the next Luxottica. Really fantastic. And so it was great. It can bring it to life, and they could take questions and all that kind of thing, because that was live. But then we can use that on our website, and people can have a look and see the kind of things that we're investing in.
I think those that they provide great sort of insight and education for people who are looking at how do people invest. I thought the questionnaire was great. So let me summarize that. Firstly, I think you come across as someone who's very grounded and down to earth. I think that the team approach to Amati really does stand out. It's no doubt been incredibly successful. You've seen this fund scale substantially over the last 5 years. The 5-year track record is good. I love the approach of sharing information within the team. And it's different. You are exposed to other areas of the market where a lot of fund managers don't go. So, Bartek, oil and gas, and I haven't looked at the strategic metals fund, so we'll take a closer look at that. Let me conclude by asking something of a personal experience. So you're one of the few managers I know who's actually taken part in the Edinburgh Fringe and actually been on stage with Marion. What was that like?
Oh, that was actually quite fun. I enjoyed it so much that I did it twice. I was quite scared beforehand because I was on with 2 comedians as well, and the advice I got beforehand was just don't try and be funny, because they're the funny ones. Yeah. But Simon Evans was one of the participants, and he's actually great. He's one of the very few sort of right of centre comedians that's really allowed to talk about anything, I think. And he has done quite a lot. He does quite a lot on the news quiz and things like that. He's very bright, very funny, and so. But he's very well read. He had a show about economics, a sort of comedy economics show on Radio 4 as well. So he's very well read in that whole area. And so it was really fun. It went so much faster than I thought it was going to do. It just whizzed by. Yeah. And it was a really wide-ranging, go-anywhere conversation. We'd started off each session, to pick an Adam Smith quote. Yeah. And so it was in Panmure House, which is the last residence of Adam Smith, isn't it? Yeah, absolutely. And it's now been renovated beautifully. Okay. So that was really good fun, and I'm hoping that Merrin's hoping that she'll be doing another Fringe show this year. So hopefully I'll be back on. That would be amazing, because last year, because of the pandemic, there wasn't. So yeah, well, we'll look forward to seeing that, and hopefully, would be really good. I might tune in. Anna, it's been a huge pleasure having you on Vantage. Thank you very much for being forthright, open about the way you do things. I think you've provided our audience with exactly what we're looking for: a little bit of entertainment, a lot of education, and some ideas to go and take a look at. Thank you very much. Pleasure.